For most of modern history, silver behaved like a normal market. Prices moved, buyers and sellers adjusted, and the system found balance without much drama. But something subtle has changed. Silver still has a price, still trades every day, yet the way it reacts no longer feels natural or calm. You can sense it in the pauses, in the sudden jumps, and in how often people argue about what silver is really worth anymore. This story is not about predicting prices or promising profits. It is about understanding pressure and how systems behave when pressure lasts too long. Because when markets are healthy, they breathe. When they are stressed, they stop acting like markets and start acting like survival mechanisms. Silver today sits between two worlds that no longer move together. One world is digital, fast, and abstract. The other is physical, slow, and limited. On screens, silver trades as numbers, contracts, and promises. In the real world, it trades as bars, coins, and metal that must exist somewhere. For decades, these two worlds mirrored each other closely enough that nobody questioned the connection. The price felt real because delivery felt possible. But over time, paper silver grew faster than physical silver could ever follow, not because of fraud, but because systems reward convenience. Paper markets are efficient. They allow leverage, speed, and scale. They solve problems for large institutions that physical metal cannot. Physical silver, by contrast, is stubborn. It must be mined, refined, transported, stored, insured, and counted by humans. That difference did not matter much when supply felt abundant and demand moved slowly. But systems change when demand becomes unpredictable. Silver is not just an investment metal. It is an industrial material woven into electronics, solar panels, medicine, and modern infrastructure. Unlike gold, much of the silver used in industry is not recycled easily. It is consumed, scattered, and effectively removed from circulation. This creates a quiet tension. The same metal is expected to behave like a financial asset and an industrial input at the same time. For years, low prices discouraged new mining projects. Mines closed, exploration slowed, and future supply quietly shrank. Markets can ignore this for a long time, especially when paper contracts provide the illusion of endless availability. But illusions weaken under stress. When physical demand rises while supply struggles to respond, the system starts to feel brittle. You can see it in delivery delays, shrinking inventories, and rising premiums that never quite return to old levels. These are not dramatic collapses. They are subtle signals, like small cracks in concrete that appear long before failure. Paper markets still function, but they increasingly rely on confidence rather than abundance. Confidence works until it doesn't. Historically, markets under long-term stress do not explode. They adapt in uneven, sometimes uncomfortable ways. Rules change quietly, behavior shifts. Participants stop acting as if the system will always work the way it used to. Silver today feels like a market adjusting to limits it once believed did not exist. And when limits appear, prices are no longer just about supply and demand. They become about trust, access, and timing. This is why silver no longer trades like it once did, even if the charts still look familiar at first glance. The system is still alive, but it is no longer relaxed. When markets come under long pressure, they do not fail loudly. They adjust quietly, changing behavior in ways that feel normal until you step back. The silver market today is not broken, but it is no longer relaxed. It behaves like a system conserving energy instead of freely exchanging it. One of the clearest signs of this shift is how rarely physical silver actually changes hands compared to how often it trades on paper. Most silver trading now happens through contracts that represent silver, not silver itself, and that distinction matters more than it used to. These contracts were designed for efficiency and flexibility, allowing institutions to hedge risk without moving heavy metal across the world. For decades, this system worked because physical supply felt abundant enough that delivery was more theoretical than necessary. Confidence filled the gap between paper and metal, and confidence is a powerful lubricant for any financial system. But confidence changes when physical demand becomes less predictable and supply becomes harder to expand quickly. Silver is consumed by modern life in quiet ways, embedded into technology that does not easily give it back. Unlike assets stored in vaults, much industrial silver is scattered permanently, making future supply more dependent on mining. Mining, however, does not respond quickly to price signals, especially after years of low prices discourage investment. This creates a delayed reaction, where demand can rise faster than supply can realistically follow. Paper markets are good at smoothing delays, but they cannot create metal where none exists. As pressure builds, the system adapts by discouraging stress points rather than confronting them directly. Delivery becomes less attractive, settlement becomes more flexible, and participants are guided toward easier outcomes. None of this feels dramatic in isolation, but together it reshapes how the market functions. The price still moves, but it increasingly reflects liquidity and sentiment rather than immediate physical availability. At the same time, physical silver develops its own signals, visible in premiums, wait times, and availability at the retail level. These signals do not always appear on charts, but they influence behavior quietly and persistently. Over time, participants adjust expectations, no longer assuming that paper exposure guarantees physical access. This is how systems survive under strain, by changing assumptions rather than collapsing outright. Silver today exists in this in-between state, where the rules still work but no longer mean what they once did. The market continues, but it moves with caution, shaped more by limits than by abundance. And when a market reaches that stage, it stops behaving like a normal market, even if it still looks familiar. When markets lose abundance, they begin to value control. Silver has slowly moved from a system of flow to a system of management. This shift is not announced, but it can be felt in how institutions communicate, hedge risk, and design rules around participation. In a relaxed market, rules are background details. In a stressed market, rules become tools that shape behavior without force. The silver market now relies heavily on incentives rather than enforcement to guide participants away from physical stress points. Contracts still offer delivery, but the structure makes alternatives more comfortable, more predictable, and often more profitable. This is not deception, it is optimization under constraint, the same way traffic reroutes when a bridge weakens. Large players do not need panic to change behavior. They only need uncertainty to prefer flexibility over ownership. Owning physical silver introduces friction, storage costs, insurance, and responsibility that paper exposure conveniently avoids. As long as paper remains liquid, many participants accept distance from the metal as a reasonable trade-off. But distance matters more when supply chains tighten and industrial demand competes with financial expectations. Silver is pulled in two directions, one toward abstraction and speed, the other toward physical necessity and limits. These forces do not cancel each other out. They coexist, creating tension that reshapes how prices respond to events. In a normal market, rising demand signals higher prices that attract new supply over time. In a constrained market, rising demand signals rationing, prioritization, and delayed responses instead. This changes psychology. Participants stop expecting smooth resolution and start planning around uncertainty. Over time, behavior becomes defensive rather than opportunistic, even without visible crisis. This is why silver reacts strangely to news that once moved it predictably. Good news may not lift prices much. Bad news may not drop them either. The system absorbs shocks internally, redistributing stress rather than expressing it clearly. Physical holders, paper traders, and industrial users now live in slightly different versions of the same market. They see the same price but experience different realities behind it. This fragmentation is subtle, but it marks a market no longer unified by abundance. Silver continues to trade, but it does so with caution learned through pressure, not confidence born of surplus. The most important changes in the silver market do not happen during panic or headlines, but during long periods of apparent calm. When nothing dramatic is happening, systems have time to adapt quietly, adjusting behavior in ways that feel invisible at first. Silver has entered a phase where stability on the surface hides constant internal adjustment beneath the price. This is the stage where markets stop reacting and start managing themselves to avoid stress rather than express it. In a healthy market, participants push limits to discover price. In a stressed market, limits push back on participants. Silver now teaches restraint through friction, delays, and complexity instead of through obvious signals. The market still allows physical delivery, but the experience subtly encourages participants to choose alternatives. Cash settlement, rolling contracts, and synthetic exposure feel smoother than requesting metal that must be sourced and moved. This does not require conspiracy or intent. It emerges naturally when convenience becomes more valuable than certainty. Large institutions adapt easily because they operate closest to liquidity, flexibility, and negotiated outcomes. Smaller participants experience the same system as rigid and slow, even though the rules appear identical on paper. This creates a split reality where the same price describes very different experiences depending on position and scale. Over time, this changes trust not suddenly but gradually as expectations adjust to repeated friction. Markets remember stress through behavior, not memory, long after the original pressure is eased. Silver now behaves like a market that has learned to conserve itself rather than expand freely. Movement still happens, but it is guided, redirected, and softened before it reaches visible volatility. Physical silver becomes something to plan for, not something to assume will always be available when needed. This changes how industrial users, refiners, and long-term holders interact with the market. Price stops being the final answer and becomes only one signal among many others. Inventory reports, delivery language, and settlement conditions grow more important than daily price movement. This is not dysfunction. It is adaptation under constraint, the same way ecosystems change when resources tighten. Silver is still trading, still clearing, still functioning, but it is doing so with caution learned through pressure. And when a market reaches that stage, it may never behave like a normal market again, even if conditions improve. As pressure builds inside a market, the most important changes happen quietly, long before anyone agrees that something is wrong. Silver today feels calm on the surface, but that calm comes from control, not from balance or natural flow. When markets are healthy, movement solves problems. When markets are stressed, movement is managed to avoid creating new ones. Silver has shifted into a phase where stability is protected, even if that stability hides growing internal strain. This changes how price behaves because price is no longer asked to do all the work of adjustment. Instead of sharp moves, the system prefers delays, smoothing, and procedural solutions that keep tension out of sight. Physical availability becomes something negotiated rather than assumed, especially when demand arrives unevenly or unexpectedly. The market does not deny access to metal, but it gently teaches participants that access has conditions and timelines. Over time, these conditions shape behavior more effectively than any explicit rule or restriction ever could. Participants learn patience not because they want to, but because impatience no longer works the way it once did. This is why silver often seems slow to respond to news that feels important or dramatic from the outside. The system absorbs information internally before allowing it to appear in price, if it appears at all. Markets under stress prioritize continuity over expression, preferring survival to clarity. Silver now behaves less like a price discovery mechanism and more like a coordination system. It coordinates expectations between financial participants, industrial users, and physical holders without fully satisfying any group. Each group experiences the same market differently, even though they all see the same quoted price. This fragmentation reduces visible conflict, but it also reduces the honesty of simple signals. Price remains useful, but it no longer tells the whole story by itself. Understanding silver now requires observing behavior, not just watching charts or reacting to headlines. This is what makes the current phase unusual, not dramatic, but deeply different from what came before. The market still functions, but it functions with memory, shaped by years of quiet pressure. And markets that develop memory rarely return to innocence, even when conditions temporarily improve. As silver continues to operate under pressure, the most noticeable shift is not in price, but in how participants interpret silence. When a market stops reacting loudly, silence itself becomes information, signaling restraint rather than indifference or lack of interest. Silver often holds steady when tension builds elsewhere, not because nothing matters, but because the system delays expression. This delay changes how participants behave, encouraging observation and positioning instead of immediate reaction. Over time, the market teaches that patience is rewarded more consistently than speed or conviction. This is a reversal from earlier eras when decisive action often captured opportunity before supply could respond. Now, decisive action risks friction, while measured behavior aligns better with how the system allocates resources. Physical silver reinforces this lesson through availability that responds slowly and selectively to changes in demand. The metal itself sets the pace, reminding participants that production and movement follow physical limits, not financial urgency. Paper markets adjust by absorbing urgency, smoothing it into liquidity rather than translating it directly into price. This creates a gap between intention and outcome, where wanting metal is not the same as receiving it quickly. Participants gradually internalize this gap, adjusting expectations without any formal announcement or structural overhaul. Markets rarely explain themselves. They educate through repetition and consequence. Silver has repeated the same lesson quietly for years, teaching that access matters more than exposure. Exposure can be created endlessly. Access cannot. This distinction reshapes behavior across the system, from industrial buyers to long-term holders. Planning replaces speculation. Logistics replace optimism. Price remains visible, but it loses authority as the sole signal guiding decisions. Instead, participants watch flows, inventories, and delivery language for cues that price no longer provides. This makes the market feel slower, but also more deliberate and cautious. Silver is no longer rushing toward equilibrium. It is managing imbalance carefully. And when a market learns to manage imbalance, it stops behaving like a simple market at all. As this managed imbalance becomes normal, the silver market begins to shape behavior before participants even make decisions. People stop asking what silver should do and start asking how the system will allow it to behave this time. This shift is subtle, but it changes motivation, replacing curiosity and conviction with caution and procedural thinking. Markets under pressure prefer predictability, even if that predictability comes at the cost of openness or simplicity. Silver now rewards those who understand timing, structure, and process more than those who react to price alone. This makes the market feel less emotional, but also less intuitive for those expecting clear cause and effect. When demand rises, the response is rarely immediate, creating a sense that the market is always slightly behind events. That delay is not accidental. It acts as a buffer, preventing sudden strain from overwhelming physical constraints. Buffers protect systems, but they also distort signals, making it harder to know where real pressure exists. Participants learn to read secondary indicators, not because they want complexity, but because simplicity no longer works. The market trains attention away from headlines and toward patterns that repeat quietly over time. This rewards experience and observation, while punishing urgency and overconfidence. Silver becomes less about reacting to moments and more about navigating an environment shaped by limits. In this environment, certainty fades, replaced by probabilities that shift slowly rather than decisively. The market does not deny reality, but it stretches it, spreading adjustment across time instead of price. This creates endurance, not efficiency, allowing the system to continue without dramatic interruption. Endurance is valuable, but it changes expectations for everyone involved. Silver is no longer expected to resolve tension quickly, only to carry it forward without breaking. That expectation alone changes how the market feels, even on quiet days. What remains is not confusion, but a different rhythm, slower, heavier, and shaped by restraint. And markets with a different rhythm demand patience, not prediction, from those who try to understand them. When long-term pressure settles into a market, the first thing that changes is not price, but behavior, as the system quietly adjusts to protect itself. Silver now moves inside a framework shaped less by free exchange and more by caution learned over years of uneven supply and demand. What once felt like a flexible, responsive market now feels deliberate, almost careful, as if every movement is being weighed before it happens. This is not fear or dysfunction, but adaptation, the same way organisms conserve energy when resources stop feeling unlimited. Price still exists and still moves, but it no longer carries the full responsibility of resolving tension inside the system. Instead, tension is stretched across time, absorbed by procedures, logistics, and expectations rather than released through sharp price action. Physical silver reinforces this behavior by responding slowly to changes, reminding participants that metal follows reality, not urgency. Access becomes something arranged and anticipated, not something assumed to be instantly available at a quoted price. Over time, this reshapes how people think about silver, replacing confidence in immediacy with respect for constraint. Markets shaped by constraint do not encourage impulsive behavior, because impulse collides with friction more often than it succeeds. Silver has taught this lesson repeatedly, and participants have adjusted without needing explicit warnings or dramatic events. This adjustment changes the meaning of stability, turning it into something maintained rather than something discovered naturally. Calm no longer means balance, but control, and control becomes the quiet priority of the entire system. What looks like hesitation from the outside is often coordination happening behind the scenes. The market continues to function, but it does so with awareness shaped by limits that cannot be ignored or bypassed. This awareness slows movement, but it also reduces the risk of sudden failure or shock. Silver is no longer racing toward equilibrium. It is managing imbalance carefully and continuously. And a market that manages imbalance stops behaving like a normal market, even when nothing appears wrong. When a market reaches prolonged limits, it stops thinking in terms of expansion and starts organizing itself around endurance and survival. Silver has arrived at this stage quietly, shaped not by a single shock, but by years of operating under conditions that never fully eased. The system no longer assumes that balance will naturally return, so it builds behavior around caution, continuity, and controlled movement. This changes how supply, demand, and price interact, turning what was once fluid into something carefully moderated. Pressure does not disappear, but it is redistributed across time, rules, logistics, and expectations rather than expressed openly. Silver becomes a market that absorbs tension internally, choosing restraint over reaction and stability over clarity. What once felt like transparency is replaced by structure, where outcomes depend more on process than on immediate signals. This makes the market harder to read, but also harder to disrupt suddenly or accidentally. Participants learn to navigate silver by observing behavior patterns rather than trusting price alone to tell the full story. Availability, timing, and access quietly become more important than numerical value on a screen. The market still functions smoothly enough to avoid alarm, yet differently enough to feel unfamiliar to those who remember abundance. Calm no longer reflects balance, but management, a state where pressure is held in place instead of released. Silver carries the memory of constraint in every interaction, shaping decisions even when conditions appear stable. That memory influences how much the system is willing to reveal, allow, or accelerate at any moment. Markets that develop this kind of memory do not revert easily, even when stress temporarily recedes. Silver is no longer just responding to the present, it is acting with awareness of its own limits. And once a market internalizes its limits, it stops behaving like a normal market forever.